There are a lot of things that are driving the forex and the equity markets currently, but at the forefront, on top of the new variant news, is the rhetoric that we're seeing from central banks and the expectations as to what central banks are going to do. Now, I understand that this is a pretty dry topic. I didn't love learning about it when I first started trading, but it is super important, especially now as central banks are starting to make a major shift, and it's really going to impact how we approach things and how we need to look at the market before we take a trade. So let's talk about everything that we need to know. First off, what do central banks do? Essentially, central banks are put in place to do their best to try and achieve maximum employment while keeping inflation tame. Now, without going into too many details, this gets challenging because they're somewhat inversely correlated. Unemployment starts to improve, inflation can start to creep up as well. And that is exactly what we are seeing today. The second question is, how do they do this? Central banks manage unemployment and inflation and a whole bunch of other factors by using different monetary policy tools at their disposal. Two of the most commonly used and commonly discussed is quantitative easing, which is essentially central banks buying government debt to increase the money supply. So it's just flooding the system with more money so it can more easily circulate, and that is to try and jumpstart the economy. So whenever you see tapering, stimulus, think quantitative easing. It's really just a fancy word. But the second thing that they do is they move and work with interest rates. And that is really what you need to keep your eye on at all times when you're trading, especially now. So in regards to interest rates, the next question would be, why is this important and how does this impact our trading? Put it in the absolute simplest? I think that's the word, simplest. Put it in the most simple terms. When the economy is doing well, interest rates tend to rise. And when an economy is not doing so well, interest rates fall. The reasoning behind this is the economy is struggling. By lowering interest rates, businesses are more easily going to be able to borrow money, which they can then use to jumpstart their business or add stimulus to their business or do whatever they want with it to help their business. And the idea is that this lower borrowing cost will really give the economy a big boost. Now, before 2008, interest rates were pretty high. And since the financial crisis, interest rates have been at an absolute all-time low. But eventually, central banks do somewhat achieve their goal. Economies improve, people are getting back to work, there's less people that are unemployed. And so at a certain point, they need to start increasing those interest rates. In our current environment, especially in equities specifically, the market has grown so accustomed and so addicted to basically free money that anytime there is talk of an interest rate hike, it really spooks the market. This happened in 2018 when there were fears that interest rates were going to hike, and the S&P 500 dropped over 20% in just 3 months. So the concerns are absolutely legitimate and they can really move markets. And so that brings us to our current environment, which is somewhat tricky because globally, we're still recovering from March of 2020 when COVID hit and all of the repercussions that has had on not just the global economy, but on the global supply chain as well. But fortunately, things are starting to improve. The unemployment rate is a lot lower than it was in the middle of the pandemic. The real concern at this point is inflation. I'm sure many of you have noticed that things are getting pretty expensive, and I'm sure you've seen in the news a lot of talk of inflation, and it's a real concern not only for you and I, but also for central banks. If inflation runs too hot, then you have a serious problem on your hands, and we have seen this happen throughout history, and even today with quite a few countries, especially in South America. As Bloomberg writes, with Omicron now circulating in the US, presenting upside risks for inflation, the next week's CPI release is likely to show the highest inflation since 1982. And they do not expect the weak jobs report from last week to stop the central bank from announcing a faster taper. The surge in inflation this year reflects resilient demand, fragile transportation networks, and shortages of both supplies and labor. So the Federal Reserve and central banks around the world are going to need to start increasing interest rates in order to lower inflation. And of course, this is spooking the market. market. So if we take this entire broad overview and we apply it directly to our trading, what do we need to keep in mind? Because I understand this might be boring. We just want to make some money. First things first is we need to see at what pace are central banks going to increase rates, how many rate hikes are there going to be, and what banks are going to do it first. Tonight we have the RBA interest rate decision. New Zealand has actually already started to increase interest rates. So when this happens, usually a currency will strengthen. It might not strengthen the exact day that the hike is announced because it might already be priced in. There could be some rhetoric that isn't as hawkish as expected, but in the long run, it is bullish for a currency. A higher interest rate means that the economy is doing well. People are more likely to put money into that country. And there's also a carry trade, which I won't talk about, but it's another reason for why a currency will strengthen if there are higher interest rates. So all of that to say, when we do see a central bank saying that they're going to increase interest rates, that should be a bullish sign for us, and that should help us develop our bias. Alternatively, we need to look at equities to see how the equity market reacts to this news. The Federal Reserve is going to be discussing their plans very soon, and so we need to watch very closely how the equity market reacts. Not only for those of us that trade or invest in the stock market, but to get a sense on risk sentiment. Like I said, in 2018, equities took a big nosedive, and if there are a lot of fears that a lot of hikes are on the way, that could spook the market. Then we would want to be long safe haven currencies such as the Japanese yen and most likely the US dollar, as everyone getting out of their stocks will be flooding to the dollar. So those are a couple things that you really need to keep in mind. I highly encourage you to do a little bit more research for yourself. It can be at times a little bit confusing staying on top of all of the correlations, but that is really the lesson here. You need to understand the correlations to be able to apply this news and this new changing environment to your trading. Nobody is going to write online that the RBA is hiking interest rates and so you need to take this trade or that trade. You need to have the knowledge so you can actually apply it to your own trading, because nobody's going to do it for you. So to summarize, inflation is running hot and the global economy is improving, so central banks around the world are starting to taper their stimulus and hike interest rates, which is going to scare the equity market but might provide some strong support for these countries that are increasing rates. So we need to watch very closely to see how stocks react to then help us develop a bias. I hope all of that makes sense. There's a lot of moving pieces. If you have questions, let me know in the comment section. I can make additional videos about this, but I do think that in our current environment, this stuff is really important. So I do encourage you to do a little bit of work and try and apply it to your trading. The bare minimum, you should keep your eyes on the news to help you potentially not get into a trade that could turn out to not go so well because of what a central bank is saying. I hope that was somewhat coherent. If you guys are still here, you have my gratitude. I'll see you in the next video, and until then, peace.